Hi guys, I'm making the final recording for audit and assurance, and I'll be speaking about internal audit. Remember that this paper is all about external audit. So we've looked at planning of external audit, we've looked at how do you test controls, we've looked at how do you perform substantive testing. And we've also spoken about how to complete the audit, what are the completion activities, including the reporting. We've looked at all of that. But now we want to touch on internal audit, which is different from external audit, but you are also required to have an understanding of internal audit. So the way I'm going to touch on it, I'm going to focus on things you are meant to know. So I'll give you a bit of introduction about it. Why do we need internal audit? We looked at that, and sometimes they are not able to deliver on their objectives, so limitations. What will stop them from being able to deliver? Then we will compare internal audit. You are meant to know the difference between internal audit and external audit, and this is a popular exam question. Then the lastly is how does this impact on external audit? So we'll look at how external auditors can place reliance on internal audit work. So we're going to look at that, and that will be the final thing we'll look at. So very important, this is the structure we're going to follow. So a bit about introduction. Now that's what I want to talk about. So look at a company. Every company is owned by several shareholders. So you have shareholders. And these shareholders, they are not involved in the day-to-day operation of the company. The company is being managed by management, then maybe supervised by the director. Right. So basically what we're saying is that it's the management and the directors that are involved in how a particular company is being managed in terms of day-to-day operations and control. And these shareholders, they are not fully involved, and they are the owners of the company. So in order to protect the interests of the shareholders, definitely you need what we call a good governance process. A good governance process. Very important. It's critical. Let me put it like that. So that with all of these, company is able to put in place good risk management framework. So we have to mitigate risk, because mitigating risk means that you are able to achieve the company's objective, and not the director's objective, not the management objective, but most importantly, the shareholders' objective of creating the company. Right? And in order to mitigate risks, there are three layers of frameworks that you are expected to have as a company. The best practice is that number one, there should be internal control. Internal controls, we mean the processes, the policies, the procedure, or guidelines, call it whatever, the management have put in place to ensure that the objective of the company is achieved. So that is what we call the internal controls, which we've looked at when we're looking at control testing. If you remember in the section C of the syllabus, we looked at internal controls there. Apart from internal controls is the first layer. The second layer that I'm talking about now is the internal audit. Which is what we're talking about in this part, internal audit. An internal audit here, what we're looking at is set of professionals. So these are a set of professionals. Let me put a description here. So these guys are professionals. Yeah, and usually they are employees. Sometimes they can be outsourced, but even when they are outsourced, they will still be working as if they are employees of the company. And what do? They provide that independent assessment. Yeah, though their independence is not that fantastic because they are staff. Yeah, so but they are still independent. Yeah, compared to the people who are doing the work themselves. And so they're out of the process. So they provide independent assessment of two things. Number one, effectiveness of risk management. And number two, effectiveness of internal control. So they provide independent assessment to show that there's a good risk management in place. Yeah, and likewise, there's good internal control in place. Those are the two things that they focus on, right? And that's what we'll be looking at today. Yeah, but there's still a third one, which is the external audit. All of this, just trying to be sure that a company is being managed and controlled properly. So all of these help the shareholders get assurance that things are working properly in the company. So that if this one fails, this one will pass or check it out. And if this one fails, this one will call it out. So this is 1, this is 2, and this is 3, right? Right. So, and one thing you should know is this independence is very critical. Yeah. And it's even much solidified with the fact that internal auditors, they don't report the management, they report to the board of directors. Because they report to a committee of the board that is called internal audit committee, not internal. Let's call them audit committee. Audit committees, these guys are made up of mostly non-executive directors, yeah, and their board members. And all the reports, all the work of internal audit, they report to these guys. Yeah, they only report administratively to the CEO, not their work. Their work does not go to CEO. But when it comes to maybe logistics, maybe they want to travel to something, they need someone to approve their expenses or something. Yeah, CEO can be doing all of that, right? Now that is a bit of intro. Let's step it up a bit. Why do we need internal audits? Why? Why does a company need internal audit? Invariably, what we're saying is that what are the roles? What are the advantages of having it? What do they perform? What do they do? Yeah, that is practically what we are asking when we say why internal audit. It's about the roles. And I'll quickly mention them to you. Like I said earlier, they do this. Right? So what it means that they monitor internal control. So you see these are the guys that will go to from department to another, checking their processes and asking whether they have controls. And even if those departments have controls, these guys will test to check that those controls are working. They're asking, do you have a policy for this? Okay, how do you do this? Okay, if you have a policy, are you doing it in accordance with the policy? That's internal control, yeah. Which is similar to what external auditors will also do when they are testing controls. But you're supposed to do it as a company first before an external party even comes to check it for you. Right? They also check for compliance with laws and regulations so that you don't want a company to start flouting rules. Yeah. So they check that their company is in compliance with laws and regulations. Very important. Likewise, they are the one that will do fraud investigation in the company. So if finance director is stealing money, an investigation needs to be done. Internal auditors can do it, except you decide to take it to the external party or consultant. Yeah, but naturally, fraud investigation is for the internal auditors. Very important. More to come is that they also perform financial statement audit. So it's not only external auditors that are meant to be auditing financial statement. Like I said, almost everything that external auditors are doing, internal auditors should have done it and even done more. That's what you're saying, yeah. So they also do financial reporting review. What do you call it? Audit. Yeah, because they are meant to ensure that financial reporting is accurate and timely. Right? They also check for efficiency of operations. This is the part that external auditors usually will not have any business. However, the internal auditors will check that our operations are efficient. We want to check that we are not wasting money. Yeah, including even IT environment. IT, they will check IT. Are we investing appropriately or we are wasting money? So another thing they do is value for money audits, which is similar to efficiency, but goes beyond efficiency, because when we are talking about value for money, we are talking about three things. We're talking that we are spending money in an economical way. We are achieving our objective, which means we are effective. And we are efficient, which means no wastages. So three things value for money is looking at: economical, effectiveness, and efficiency. Yeah. So very good roles, as you can see them. They are really, every company needs all these things to be done. But sometimes these guys are unable to deliver these objectives. They are unable to deliver these fantastic objectives that we've identified. And that is talking about their limitations. So we need to know why. Sometimes what stops them? What are their limitations? Yeah. And the first one, I've already alluded to it when we started, is the fact that their independence is usually impaired. Although we know they report to the board of directors, but they are still staff. Yeah. So that independence is not as perfect as you would have expected it if they are external people, like external auditors. Yeah, because this might be coming from, maybe they are afraid, it might be coming from fear, intimidation. That, no, this guy is a manager. I cannot report him that his processes is bad. Yeah. So, like I said, because they are staff. So they are still within the company. And because they are still within the company, it's difficult for them to separate themselves fully from the company and say they can say whatever they need to say, except the company is really very strong with protecting them, which rarely you will find. Yeah. Likewise, they are limited because there's no statutory backing. Yeah. Remember, for external audit, is statutory. You must do external audit by external auditor, and if you don't do it, or if your result is bad, then your company is going down invariably. Yeah, so everybody wants their audit report to be nice because going outside there, the public will see it. But for internal audit, it's not the same. There's no requirement that you must have internal audit department or you must do it. Yeah, especially if you are not a listed entity, right? And likewise, even your report doesn't go to the outside. Even if you are listed, your internal audit report doesn't go out. It's within the company. Unlike external audit, that your report goes out, everybody will see it if you are listed, right? So that lack of statutory backing does not allow them to really deliver their task at the best. Likewise, because they are also staff, they are exposed to familiarity threats. Familiarity threat. Yeah. Because their friends, they might be auditing their friends or someone that they go to lunch together. Some confidential information might be divulged, or even they are trying to protect their friends that has not done what it's supposed to do, but because they're friends, they're going to have Good Friday together or have something on the weekend. They don't want to ruin their weekend. So the guy will want to protect his friend and will not report with the weakness that he has found. Yeah, so that's a problem for them. Okay. And likewise, the appointment can be manipulated. And I will tell you why. Because they are still going to be recruited by the management. And in that case, if management does not want that particular role to be strong, all they need to do is to appoint or is to recruit incompetent people. Yeah, so when you put incompetent people in that department, then you cannot expect quality work to come, because they don't even have the right skills to be able to do it. Yeah. So what I was saying here is that they can employ incompetent people. Okay. And likewise, even if you've employed people that are good, in a place of audit, which you will see in the external audit, they keep improving those people, they keep training them, they keep exposing them, investing in them such that they know what they are doing and can also move with the dynamic nature of industries. However, for internal audit, there can be poor investment because management doesn't want them to be able to call them out. So, poor investment in the function. And because they are not like critical in terms of the front line of the business, the operation itself. So they might not be getting the right attention in terms of resources and all. And when there is poor investment, what do you expect? There will be poor quality of work. The final one I'm going to mention here is the fact that their scope of work could also be manipulated. Yeah, scope of work. Because what they will look at is also going to be approved by the management, and also though the board will look at it, but there's a way management can make them focus on areas or divert their attention from the areas where they should be looking at. Yeah, so that manipulation is also a limitation when they are not able to look at what they should be looking at. Right. So all of these 6 are limitations of internal audit. You can take a picture of it. Yeah, very popular in exams. Yeah, these are advantages. I mean, there are rows. That's what we've looked at here. Please take note of that as well. And I gave you a bit of introduction. So with that, with this, with that, with this, with that, with this. Now, quickly, let's compare internal audit and external audit. Yeah, how are they different? That's what we want to focus on, the differences between external audit and internal audit. Very popular question in exam. And the way I want to deal with this is I'll use a table so that you can also take a picture, and that should make sense to you. So we'll look at it from what are the things we are looking at in terms of what could make a difference. Then we'll talk about it for both the external and the internal audit. Yeah. So let's put external audit here. So external auditors. And I'll make this internal auditors. So we'll start with reporting. Who do they report to? That is number one difference that I want to look at. For reporting, external auditors, they report to shareholders because those are the people that employ them. So they report to the shareholders. But internal auditors, they report to the board of directors through audit committee. So I'll say audit committee, and that is board of directors. Where do they get their power from? That is the next one. Where do they get their power from? External auditors get their power from statutory law. They have statutory backing, as we spoke about earlier. Whereas management are the ones that put in place internal audit, and also the power is from the management. And that's why they are exposed to a lot of manipulation from the management. Who are the employers of the auditors? Straightforward here. For external audit, the external audit firm, obviously, the likes of PwC, KPMG. So the external audit firm, you're talking about PwC, KPMG, Deloitte, EY, those are the employers of the auditors. Whereas when you are talking of internal auditors, usually the company. Same company that they are auditing are the employers. Another difference that we can see is what are their objectives? Why do we have them objectives? For external auditors, the objective is to provide credibility on financial statement. That financial statement that has been prepared by the management to the shareholders, the external auditors will come look at it and say this financial statement represents true and fair view of the affairs of the company. That is the objective. But for internal audit, they are more focusing on risk management and internal control. Okay, it's not that they don't look at financial statement at all, but that is the core objective. So these guys provide credibility, by the nature of their opinion on what? On financial statement. This financial statement, remember, is prepared by management to shareholders. So shareholders cannot just trust the management, and they need external auditors to come look at it and give them assurance. But for the internal auditors, the objective is to evaluate risk management, and internal control. That is our objective. Still going, there are more. You need to know a lot because this usually might be 5-mark question in exams. Let's look at their coverage in terms of scope of work. Their subject. What is their focus? What do they work on? Coverage. Almost like talking about the subject of the work. For external auditors, very straightforward, strictly financial statement. Whereas for internal auditors, it's actually the entire business. They are meant to look at the entire business, but especially with the risk areas. They look at the entire business, identify the risk areas, and they check operations, everything. Yeah, so they look at every part of the business, not just financial statement. And the last difference I'm going to give you is recommendations. Yes, that's another one. Yeah. Are they meant to give recommendations? Are they required? So I'll call it obligation to provide recommendation. Obligation to provide recommendation. Obligation to provide recommendation. Remember, recommendation is about providing ideas on how things can get better. Yeah. So for external audits, they don't have any obligation to do that. Although they give it if they find it so that they can add value to the client, but there is no obligation. But for internal auditors, that is their main objective, to be able to provide recommendations on how things can get better for the company. So they have obligation. So here there is no obligation, but for the internal audit, there is obligation. Please take note. Those are the major differences, and you need to know them. It's extremely important. You can be tested in exams. In fact, anytime you see internal audit question, most likely you will be asked to compare internal and external audit. Yeah, very important. Yeah, you can take a picture of it. Yeah, so let me make it easier for you. Yeah, this is it. Yeah, you can take a picture of it quickly. Right. And the last part for this part of the syllabus is the usage of internal audit work. Yeah. So for external auditors, do we use internal audit work? Yes, we do. Because every time we are looking at controls and we're relying on controls, we're also relying on the fact that internal auditors should have looked at them. And this is guided by ACCA 3610, in case you want to know. Yeah. ACCA 610. Yeah. And what are the kind of work that IA auditors, what do they do that we can rely on? Yeah. So external auditors can rely on few things that these guys have done. They are control testing. Because they've done control testing, external auditors might want to rely on it so that we don't have to test a lot. Likewise, even inventory count. Yeah, because most times internal auditors, they will also be involved in inventory count. They will observe it. So we can rely on their report. Yeah. So we can rely on their work. However, there are things the ISA 3610 want us to consider before we can start relying on their work. So we need to consider some things that must be in place before we can decide to rely on their work. Yeah, and that is the critical thing here, according to ISA 610. And that is what you really need to know. Before auditors can rely on internal audit work, number one thing they must review is that those RA guys have the right qualifications. So you must check the qualifications of the RA auditors to be sure that their qualifications are intact. They must also have the right experience. The experience also matters. If they have good experience, then you can rely on their work. Yeah. Likewise, you need to check the quality of their work. How do they come about the outcome of their work? Yeah. Do they get to do their planning properly? Do they plan their work properly? Yeah. What about supervision? Do they get their work reviewed? Yeah, very important. And likewise, the documentations, is it detailed? their documentations of their work, is it detailed? Yeah, and lastly is whether their recommendations is taken seriously by the management. So if not, if their work is not taken seriously, then we can't rely on it. Yeah, if management does not take them seriously, then too bad. So if IA recommendations are taken seriously by the management. So if all of these are in place, then we can rely on internal audit work as external auditors. Yeah, very important. Please take notes. This is very, very critical for you because this is where it links to external audit. If you don't know anything at all, please note these 4 conditions. Yeah, these are the conditions before you can rely on internal audit work. Yeah, and that's where I will end it for this internal audit subject. If you have any question, remember, please put it on the comments and reach out to me if need be. Yeah, all right. Thank you. Bye for now.